I think we're going to blow that stuff out and get it far enough beyond it to where people have to then sit down and say, golly, I missed it. And right now, from everything I read, and I don't pay a lot of attention to this stuff, but the average investor's portfolio in gold, et cetera, is so trivial in the US particularly that it's laughing. I saw a Bank of America statement of positions of people in various asset categories, and gold was like off the page. It was like less than 1%. They still don't believe it. And yet it's been beating the stock market for not just a year or two, but really since the 2015 low. Gold is far above where it was then. And you can go back 3 years or 5 years, but they don't acknowledge it. It's not on CNBC. It's not on Fox Business News. Oh yeah, recent strength has been, but they don't realize that it's been beating. And now silver, if you look at where it is in relation to the S&P, we ran charts on it a couple weeks ago. It's beating the pants off the S&P, but nobody's aware of that. Anyway, that's going to shift. And when the public finally realizes that, ooh, I missed it, or ooh, it's been doing well, and ooh, the stock market's not doing so well, because these new highs in the stock market are a bear trap. A bull trap, which people think a new price high means something. I don't know where gold's going on this move, frankly. I've said over and over again, and this is not a target. I'm just simply citing a fact. But the ratio scale bull trends of the past 50 years, like up to 1980 peak from the 76 low, was an eightfold move. From the 2001 basing process at $260 gold, the next move up to 1920 was an eightfold move. Well, if we have another eightfold move, just another, did it again, okay, ratio move, would be $8,000, $9,000 gold. That's just doing what we've done twice before, so it's hardly some, unrealistic expectation. But there are different factors at play now. I can see them technically, and I know fundamentally they're there. And those factors are the kind of factors that this time around, the boom-bust cycle doesn't just end with the bust and then they print the money and we go back up and have another boom again. This time it's different. The consequences will be far greater and the upturn will be more laborious from very painful levels on those assets that are about to bust. And there will be a realization on the part of academicians, intellectuals, economists, lagged to reality, but they will recognize that, hey, you know what? This central bank game we've had for 100 years now, it's just created boom-bust cycles. They boom the money supply, cut rates arbitrarily, and we get a nice boom next year or 2, 3, 5 after. Prices of the stock market goes up, and then it busts. And they try to rescue it by cutting rates all the way down, but it never works. And, this game has been going on for 100 years. One long human lifetime, the central bank has been around, our central. And if it isn't working, then that realization comes into play where, hey, this time it didn't work. It's not working. We need something else. And that's when the public, especially when you hit them with pain, like their only thing they've got to smile about, I've mentioned this before, is, their 401k. Trump pounded the table the other day. Your 401k is all-time new high, et cetera, et cetera. Well, if it isn't, and that gets taken away quickly, like suddenly it's down 30, 40%, and you look around and all of a sudden layoffs are occurring, and mortgage rates are killing you, and I've maxed out my credit card. You get the point. All these things coalesce to where you have nothing but pain. There's no smiling place to look at. That's when hands go up in the air and people say, we got to do something different. They don't quite know what to do. They just know it's panic. And that's when institutions and realities we think were permanent aren't going to be permanent. And I think one of the things we're going to go back to is what used to be reality, and that is money that's backed by gold. And it wouldn't surprise me that the Chinese are the first to do it. What a world we live in. Who would think? But I think that's coming. And I don't know at what price level gold might ultimately be in silver when that occurs.
Right now, the average investor still doesn't believe. That's the truth. I don't care what the price chart says or what Wall Street headlines are talking about for 5 minutes before going back to AI stocks. Most people still treat gold like a fringe asset. It's barely on their radar. I saw a recent breakdown from Bank of America that made me laugh. The allocation to gold and precious metals across portfolios, particularly in the United States, was barely measurable. Less than 1% off the page. It was like they forgot gold exists. Now, why does that matter? Because this kind of neglect, this total lack of positioning, means the upside has barely even started. When gold and silver move, and I mean really move, it's not just a function of price or momentum. It's about realization. It's about that moment when the investing public says, golly, I missed it. That moment of psychological capitulation is when gold stops being an afterthought and becomes the headline. And we're getting close to that moment. I don't know exactly when, but I do know this. The chart says it's coming, and the momentum agrees. Most investors still think this is just a spike, a little volatility, maybe some safe haven jitters. They don't realize gold has been beating the S&P for years, not just since 2020, not just during COVID. Go back to the 2015 low and compare the performance of gold to the stock market. Gold wins. Silver? Same story. We ran the relative performance charts versus the S&P just a couple weeks ago. Silver is quietly outperforming, but it's still treated like some medieval trinket. CNBC doesn't talk about it. Bloomberg barely covers it. Fox Business? Forget it. But the data is undeniable. What's coming is a psychological shift, and it won't be polite. Because here's what people don't get. Most of these new highs we're seeing in equities right now, they're bull traps. Big ones. People see a new price high and think it means something, that the system is working, that the Fed has pulled off another miracle. But they're looking at the wrong indicators. The rallies in stocks right now are illusions. They're not being supported by underlying momentum. When we analyze these moves with our structural momentum models, what we see are hollow surges. You get a price high, but no energy behind it. That's not a bull market. That's a gas for air. Gold, by contrast, is building power. It's not just price that's moving, it's the structure. The long-term metrics are aligning in a way that we've only seen a couple of times in the last half century. Back in the 1970s, from the 1976 low to the 1980 peak, we had an 8-fold move in gold. Then from the 2001 base at $260 to the 2011 peak at $1,920. Another 8-fold move. So ask yourself, what happens if gold just does the same thing again? Not a moonshot, not a fantasy, just a repeat of what it's done twice before. You're looking at 8,000 or 9,000 gold. That's not a prediction. That's just ratio scale mathematics. You don't need a monetary crisis to make that happen. But this time, we've got one coming anyway. Because here's the thing, the central banking model is broken. We've had over 100 years of this experiment, managing interest rates, printing money, controlling economic outcomes from a boardroom table. And what's the result? Boom, bust, boom, bust, every time. They flood the system with liquidity. The stock market soars, then everything collapses and they flood it again. This isn't stability, it's a perpetual crisis cycle. And now we're in the late stages of that game. This time the bust won't be followed by another boom. Or rather, it might, but it'll be hollow. Because the underlying reality is this: the debt can't be serviced. The economy can't absorb another rate hike. And the Fed can't print without stoking inflation to levels that destroy trust entirely. Sooner or later, and I think sooner, people are going to realize this model doesn't work. It never really worked. It just bought time. Time which is now running out. The public doesn't know what to do yet, but they will. When the layoffs start piling up, when mortgage rates choke housing again, when credit cards are maxed out and 401ks take a 40% haircut, then the questions begin. And when they look around and see nothing working, nothing offering a lifeline, they'll do what people have always done. They'll return to what's real. And what's real is gold. What's real is silver. These aren't assets you buy when things are good. They're assets you return to when everything else has betrayed you. It wouldn't surprise me at all if China leads the way here. They've been buying gold hand over fist, building reserves quietly while the West fiddles with interest rate futures. When the next crisis hits, don't be shocked if China's the first to officially back their currency with gold. Not because they're traditionalists, but because they're strategic. They know trust matters. And when fiat fails, trust is everything.
Yeah, it's going to be more vertical, though, than what they're used to for the last 10 years in gold, which has been a layered process. I think it's going to be far more vertical, which is going to surprise them. And yeah, there will be pullbacks, but they'll be sharp and over with quickly, and they won't be as deep as some of the other pullbacks we've seen. That's what I think is about to unfold. And his question again was the
Where are your sell points
sell points. Oh,
specifically? Yeah.
yeah, I about chuckled, pardon me. When we look at long-term momentum, such things as a three-year average oscillator, where we oscillate the price of gold versus its three-year average or versus its three-quarter average, long-term yardsticks. We're not even near any numbers that would say, oh, it's over. On short-term basis, you could always get sell signals here and there, but they're like, you get out at every sell signal, you're unlikely to get back in time. In other words, yeah, it's a trader's thing. You might drop for 2-3 weeks, but if you don't get back in 2 days later, it's back at the highs. You know what I mean? We've seen this repeatedly. We're not near any long-term momentum structural breakage points. Now, when we go back and look at peaks and troughs and go major lows and major highs in gold through history, going back to 50 years that it's been legalized, when it makes a high and turns down, it breaks structure very, very soon after making the high. Example, MSA turned major bearish on gold in January of 2012. It was only 3 months after the high, okay? And when you made your high in September, October 2011, and you dropped some, didn't do anything on a price chart, but for annual momentum of gold, it said, uh-oh, you just broke the backbone going back quite a few years on the momentum chart. So we turned major bearish. And we had to put up with a lot of complaints because most of the public wasn't willing to go bearish then. And we said, no, be gone. Well, sure enough, gold labored. After it made its high at 1920, it dropped down into the high 1500s at some point, and then lived between that level and the upper 1700s for the next year. Kept trying to go back to its high, but couldn't. So it wasn't sideways action. Was sideways action after a peak, but it had broken already 3 months off the high, its annual momentum trend. Same in 2015 when it made its low in December of 2015 at a price of 1,050. 2.5 months after that low, actually a month and a half after that low, in mid-February 2016, MSA went long-term bullish again because we had broken annual momentum trend structure to the upside. Right now, we're not even near any breakage levels. And when gold makes a high or a low, what happens is the momentum structures move up to where they're very nearby the action, so that when it breaks even modestly, it's got something to break of significance. We don't have that now. I'm not fearful of a top in gold. Quote, $50 highs, if you go back and look at them, like on a weekly chart or something, they're almost phantom highs, meaning you're up there so briefly, it's like you were hardly even there. It was just thin air and it collapsed. Okay. And those old highs, when you, of course, value silver at that time, let's say 1980 at $50 or 2011, 14 years ago. What's happened to the dollar since then? I don't mean the dollar index, but the real buying power of the money unit. It's continued to collapse.
Now let's take this further, because when the dam breaks, and it won't just be about gold hitting a new all-time high. That's almost irrelevant in the grand scheme. It'll be about trust vanishing in real time. The public won't just wake up to missed gains. They'll wake up to the revelation that the institutions they trusted, the Fed, Wall Street, the Treasury, their 401k, weren't built to preserve their wealth. They were built to harvest it. People love to think that new highs in the stock market mean something. And they do, just not what you think. These aren't signs of health. They're the final convulsions of a broken model. Bear traps dressed up as rallies. We've seen this pattern before. The dot-com top in 2000, the housing top in 2007, they were all preceded by euphoric spikes. But what made those different was that there was still another central bank card to play. You could cut rates. You could unleash new QE. You could jawbone confidence back into the system. Not this time. This time we're boxed in. If they cut rates too aggressively, inflation reaccelerates. If they raise, they break the bond market. If they do nothing, the economy grinds down under the weight of interest expense. The system has cornered itself. And when that becomes obvious, when the public no longer believes the fire department can put out the fire, then gold and silver don't just rise, they detonate. I think we're going to blow past these so-called resistance zones in gold and silver so fast that by the time Wall Street notices, it'll already be gone. The breakout will be far enough beyond those old highs that people will be forced to stop and say, wait a second, how did I miss this? And that moment of regret, that sharp public realization that they missed the train, is precisely what fuels the next leg higher. Let's talk about scale, because I've said it before and I'll say it again. If gold simply repeats its past behavior, if it follows the same ratio scale path it did from 1976 to 1980 and again from 2001 to 2011, we're looking at $8,000 or $9,000 in gold. That's not moon talk. That's just math. It's what the metal has done before in response to far less destructive conditions. This time around, the factors are more severe. We've never had $34 trillion in debt with interest costs exceeding $1 trillion per year. We've never had global central banks simultaneously tightening into a sovereign debt trap. We've never had a banking system propped up by repo facilities and liquidity backstops this large. And most importantly, we've never had a public this close to losing faith in fiat itself. That's what changes everything. This isn't just about price performance. It's about structural belief collapsing. If the only thing people have to smile about right now is their 401k, what happens when that disappears? When layoffs start accelerating, when inflation eats through what's left of disposable income, when people go to refinance and realize their mortgage is unaffordable, they won't be watching the S&P. They'll be watching the exits. And when they reach for the exit, where do they go? Where does that trillions of dollars in paper wealth flee to when there are no more safe bonds, no more cheap tech stocks, and no faith in the dollar? They go to gold. They go to silver. They go to what worked for 6,000 years. Let's be real. We've reached the moment where the only thing holding this system up is inertia. And inertia works until it doesn't. It's the Wile E. Coyote moment. He runs off the cliff, keeps going for a few seconds, looks down, then suddenly realizes there's nothing beneath his feet. And that's when gravity asserts itself. That's where we are. And I can already hear the academics. They'll come in 6 months after the crash and say, well, we couldn't have seen this coming. Yes, you could have. You just didn't want to. You didn't want to admit that your entire worldview was built on models that didn't work, on theories that never predicted anything, on monetary tools that only made things worse. You didn't want to admit that gold, not your PhD thesis, was right all along. That moment of realization won't just be personal, it will be institutional. There will be a shift, a re-rating. Central banking as a concept will be called into question. Not just policy tweaks or leadership changes. I'm talking about foundational doubt. And in that void, there will be a scramble to return to something real. And what's more real than gold? It wouldn't surprise me at all if China is the first to make the move. In fact, I'd be surprised if they didn't. They're stockpiling. They're setting up bilateral trade systems. They're issuing debt backed by real commodities. The world's largest gold importer is laying the groundwork for a new currency paradigm. It may not be explicitly gold-backed at first, but it'll be convertible. It'll be trust-based. It'll make the dollar look like a dinosaur. Now imagine the knock-on effect. Once one major economy pegs partially to gold, just even references gold as an anchor, the floodgates open. The emerging markets will pile in. They're tired of being held hostage to the dollar. And suddenly the global demand for gold isn't just speculative, it's monetary. That's when the revaluation happens. Not a rally, a repricing of what money is and what it isn't. A repricing of every balance sheet, every collateral model, every asset class in relation to real tangible wealth. And let's not forget silver, because when the monetary realization hits, silver won't be playing second fiddle. It'll be the speculative lightning rod. In real terms, adjusted for inflation, silver is laughably cheap. Those $50 highs from 1980 and 2011, they're phantom levels. In 2024 purchasing power, that's $200 plus. So what's the resistance again? A 3-week spike from 13 years ago? It's absurd. Silver's role is dual, industrial and monetary. And as the world transitions toward energy-intensive, tech-centric infrastructure, EVs, solar, microchips, the industrial demand only grows. So when the monetary side lights up, you get a two-front rally, a supply deficit on top of a currency crisis. And in that environment, silver doesn't climb. It leaps. And yet here we are, mainstream portfolios still sitting with less than 1% exposure to precious metals. The denial is breathtaking, and so is the opportunity. When the vertical move begins, and I mean truly vertical, it'll be too late to position. Physical premiums will widen, dealers will run out, miners will gap up 30% in a week. The ETF inflows will jam the system. And the same analysts who laughed at gold at $1,900 will write glowing reports at $3,800, acting like they were there the whole time. But here's the thing, this isn't about gloating. It's about surviving, thriving even. Because what we're facing is not a correction, it's a reset. Not the World Economic Forum kind, with digital IDs and carbon credits, but a reset of trust, a reset of value, a reset of what money means. And in that reset, the rules change. All the things you thought were safe, bonds, large cap stocks, even cash, become liabilities. And the things you were told to ignore, gold, silver, land, skills, become priceless. So what do? You get ahead of it. You exit the illusion. You accumulate real assets. You hedge with gold, then leverage with silver. You think like someone in 1971, not 2021. You remonetize your own portfolio before the system does it for you at terrible terms. Because when it happens, it'll be quick. The same way trust evaporates overnight. The same way currency crises spiral from stable to broken in a week. Ask anyone who's lived through one. Argentina, Turkey, Lebanon, Zimbabwe. They didn't see it coming until it was already here. And we, in the so-called stable West, think we're immune? We're not. We're the ones most vulnerable because we're the most complacent. Our systems are built entirely on paper confidence. Our economies are addicted to credit. Our central banks are out of ammo. But gold has no central banker. Silver has no yield curve to manage. These metals are free markets in a world of control freaks. And their breakout is not just inevitable, it's already in motion. The public just hasn't noticed yet, but they will. And when they do, the window will have closed. So watch the momentum, respect the structure, ignore the noise, and prepare. Because the vertical move is coming, and when it hits, there's no going back.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.